The job growth that we have seen in the last year is going to moderate, and unemployment rate will go up slightly.
At this point, after around 10 quarters, there's virtually almost no excess savings in the hand of the bottom 80% of the income distribution.
But the other is that delinquencies and charge-offs are rising.
We're looking at somewhere in the neighborhood of 750,000 or so more people out of work. That's meaningful, and not just for those 750,000 people.
Good afternoon. Welcome. So glad to see so many of you here for this session. We're very excited about it. Welcome to the breakout here this afternoon entitled Economy on the Brink. I bet Mike came up with that. First off, we wish to thank FIS for the sponsoring of today's session, the economic update this afternoon. And at this time, we're going to welcome our panelists. So we're very excited about that. Please welcome to the stage your America's Credit Unions economic team. First, we have Mike Schenk, Deputy Chief Advocacy Officer for Policy Analysis and Chief Economist, the funniest economist I know, Mike.
Never saw the sun.
Let's give it up for Mike.
So bright, never saw things going so
we also have Deweet Kabita, Senior Economist. Deweet, come on out.
days, all of them gone, nothing but blue.
Next, we have Luigi Vados, Senior Economist, and certainly, last but not least, come on out, Luigi. Last but not least, we have Kurt Long, Vice President of Research and Chief Economist. All right. Excellent. Thank you. And Mike, take it away.
Thank you, Mia. How are y'all doing? Blue sky. You're doing good. Sounds like your thought process is aligned with our baseline forecast, which is pretty rosy, calls for blue sky. We believe that the Fed will actually deliver on its promise to produce the soft landing. They don't have, as you know, a very good track record on that, but that's kind of where we're coming from at the moment. If you've been here before, you know our shtick. Basically, we'll talk about the macroeconomy and what we see in terms of developments on that front. We're going to talk a little bit about, Deweet will do that part of it. Luigi will then transition and talk about how macroeconomic developments are going to affect our members. And then Kurt will bring it all together at the end with the most important part, where we're going to talk about how macroeconomic developments and the effect on consumers will influence your interactions with members and member behavior and that sort of thing, how that shows up financially for your credit union on the balance sheet and income statement. So that's kind of how we do it. And if you've been here before, you know that I always like to start out by not talking about the economy at all. So just for a minute or two, I want to remind you, level set, that trade association economists are here not to forecast the economy. We are here to provide data for our advocacy efforts. And that's basically why they send us paychecks. We want to be able to tell the world, anybody who will listen, policymakers, consumers generally, the press, we want to be able to tell anybody who will listen what credit unions are all about and why they can benefit from credit unions, but essentially tell them about the transformative power of cooperative finance. So we bring data to the table to try to get policymakers to do fewer bad things to you, more good things for you, and hopefully, in a lot of cases, to get them to undo some of the bad stuff that they've done historically. In any case, I did want to just take a minute or two to talk about, this is sort of my personal impact dashboard, some of the data that we've been collecting since we last met last year at the GAC. This is just spaghetti on the wall kind of thing, where I noodled through, so to speak, the activities that we've been engaged in over the course of the last 12 months. And I have a lot of good news to deliver on that front. As you know, we use the in-plan input-output model to try to measure the economic impact that you all collectively have throughout the United States. We reran that model with new data, and what we found was that credit unions collectively have a big economic impact. And here we're looking at direct impacts, indirect impacts, and induced impacts. And in terms of output, credit unions collectively account for $220 billion in economic output. You employ about 300,000, actually a little bit over 300,000 individuals in your credit unions, and those add-on effects, the multiplier effects, essentially come out to over 900,000 total employment throughout the United States because of what you do in communities across the nation. So those numbers at the moment are at all-time highs, and you should be very happy about that. The in-plan model also estimates, of course, it accounts for the fact that you do not pay federal income taxes. The bankers like to actually talk about that in a very strange way. They say that credit unions don't pay taxes. One of the really nice things about having in-plan data is we can get pretty solid estimates on the taxes that you do pay. And you can see up here in the last year that we have data for, the last tax year, $17 billion in federal taxes paid by credit unions collectively, and $10 billion in state and local taxes paid by credit unions. And actually, more importantly, I would say, is that we're also able to estimate that our member owners paid a total of $1.8 trillion in taxes over the course of the last year. $1.8 trillion. And as you know, a tax on your credit union is a tax on our 140 million credit union members. So very impactful data. Again, all of these numbers are at record highs at the moment. We measure financial benefits. We've been doing that for a while as well. Overall, direct financial benefits to credit unions, $22 billion. That's lower fees, fewer fees, lower interest rates on loans and higher interest rates on savings accounts, $22 billion in the last year. And if you add the indirect benefits that accrue to non-members, this arises because when credit unions are in the marketplace, for-profit banks price in more consumer-friendly ways. Add that into the total and you go from about $22 billion to nearly $30 billion in direct and indirect financial benefits throughout the nation. I should also mention that when we look at the household level, if we look at PFI or loyal members, we estimate a savings of about $700 per year for people that use a lot of credit union services. So a typical use of financial services, but all at the credit union. We find we sort of measure that typical use by looking at the Federal Reserve Survey of Consumer Finances as our starting point. We are doing a lot of work on your focus on mission, financial well-being. How are you changing people's lives? And actually, as I was about to board my plane, when I was leaving the office, I did get the results of a new survey that we did. We call it the Consumer Pulse Survey. We historically called it the Voter Survey. And I just want to throw out a couple numbers from this survey that I think you find really impactful and meaningful. When we survey consumers, we ask credit union members, 90% of them say that they are very sure that they can get a low-cost loan at a credit union. 87% say that it's easy to get a loan at a credit union. 89% say that the credit union has positively impacted their financial well-being, and 86% say that their credit union has actually cares about their financial well-being. Beyond that, when we look at trust, service, and community focus, we find that over 90%, 93% say that credit unions are in touch with their local community, and 92% they say you care about the local community. And then finally, 93% say that you can trust, I can trust my credit union. So really positive results there. And comparatively, when we ask the same question to non-members of credit unions about the financial institutions they use, the differences are really, really great. So one of the things we look at is what we call high-intensity results. Those are the people that say, yeah, I'm really sure, I'm really enthusiastic about these various metrics. Credit union members, 2.6 times more likely than non-members to say they're very sure they can get a low-cost loan. 2.2 times more likely to say it's easy to get a loan. Members are 1.5 times more likely than non-members to say that you care about their financial well-being and that you have improved their financial well-being. And then finally, by a factor of about 2, credit union members are more enthusiastic about the fact that you're in touch with the local community and you care about the local community, 1.4 times more likely to say that they can trust their institution. So really high numbers to begin with, and then the differences between what we see in the for-profit sector. People that don't use credit unions are really, really impactful. And of course, we use that quite often historically in our advocacy efforts. Really interesting, those results don't change much over time. And I think it's very impactful to mention that we look at various demographic groups. Within each key demographic group we look at, lower income people, women, people of color, people who live in rural areas, and military families, people that own businesses. Across all of those demographic groups, these results are very consistent. So pretty cool. We analyze, put all of our data, our big data sets up in the cloud, and we have HMDA up there, we have Equifax data up in the cloud, we have the Survey of Consumer Finances, call report data. As you know, there was a lot of concern about credit union mortgage lending. We did an analysis in a very short period of time, probably a day or two, that would have taken us, previous to being in the cloud, would have taken us several weeks, if not a month, to do. We did those analyses at the state level for state leagues, probably ran 100 or so very detailed reports. But the key takeaway, and I think Carrie mentioned this earlier, key takeaway is that on 115 of 159 metrics, credit unions outdid banks in terms of their performance on these really important mortgage lending statistics. So nearly 75% of the metrics, credit unions exceeded bank performance. In terms of how that compares to the data over time, well, the NCRC, the National Community Reinvestment Coalition, did a similar study back in 2009, and they found that banks beat credit unions in about 60% of the KPIs that they looked at. So the world has changed a lot. Credit union mortgage lending performance in that HMDA data is very, very positive, despite the fact that we have tight fields of membership, despite the fact that we're not subject to CRA. Nobody's telling us to do these things. It's just what we do. It's in our DNA. So fantastic data there. We finished a white paper on bank sales. We did a bunch of white papers on public deposits, variations on these national reports for a number of state leagues who were concerned about bank sales and public deposits and so forth, and a lot of good data there. We know from the Equifax data, we've said this historically all the time, consumers really are pleased with credit unions, and we believe that consumers' best financial partner are credit unions. So we now have this Equifax data, and we can prove it with the Equifax data. So for example, we know that a typical credit union borrower will save up to $11,000 on a 6-year car loan today. We know that typical credit union borrower will save up to $55,000 on a home loan, 30-year fixed rate mortgage these days. Huge savings for average consumers. And what that does, well, a couple of different things, but one of the really important things it does, those lower payments, make people more financially resilient. And so what we see with delinquency rates across the board, not just in the aggregate, but across the credit score spectrum, we see much lower delinquency rates amongst credit union members than we do see in the for-profit sector. So very impactful there as well. And then we've been building out, since we have so much data, so many questions to answer, and so many things that we want to chase down with this data, we've been inviting academics into the fold. And I talked about this last year, have 4 or 5 academic papers published really shining a bright light on the credit union difference. And there was one really impactful one that was done this year that I think bears mentioning, and that was one on student lending. So they looked at people that had student loans and tried to figure out how those people fared during the pandemic as their student loans were in forbearance. So they weren't paying on their student loans. What was the effect of that? And what they found, very interesting, what they found was, number one, across the board, essentially, borrowers viewed that forbearance as a windfall. They viewed it as a windfall. And that meant they went out and they spent more money and they borrowed more money. And then they looked a little bit deeper, and what they found is in the for-profit sector, the average borrower who was in forbearance actually increased their debt load by 25 to 30%. In the not-for-profit sector, in credit unions, that increase in debt was only 8%. So I just wanted to give you a line of sight into some of the work that we've been doing on this front in support of our advocacy efforts. I know you're here to hear what's going to happen in the macroeconomy, and so I'll pause there and turn it over to my colleague, Dawi Debede, and he'll tell you about the macroeconomy. Take it away.
All right. Thank you so much, Mike, and thank you everyone for being here. So I'll be talking to you about the macroeconomic trends, and for that I'll be focusing on 4 variables: economic output, labor market, inflation, and monetary policy to do that. So what you see here in this graph is quarterly annualized real growth rate of the GDP. And GDP is a gross domestic product. It's the value of all goods and services produced within a country in a period of time. That's one of the ways that we measure economic output. And you also see here that light blue line is the forecast from our team for the entire in 2024. So if you look closely here, this is data growth rate quarterly from 2001 up to 2023. But if you look closer, the bars for 2023 are evidence for how the economy defied expectations from every economic forecaster, and also the expectation of policymakers at the Federal Reserve. So most of the assumption that we have, and also for most forecasters last year, was monetary policy was going to be very restrictive, and for that reason, we're going to expect household spending and business spending to slow down, unemployment to go up. So we will have very slow growth, or what we call a growth that's below potential because of those reasons. So one of the assumptions is still true. Monetary policy is still very tight and it's still restrictive, but the other assumption that we have laid out, like spending and business investment, didn't hold, and unemployment also didn't increase as expected. So what you see here is on a year basis, actually, growth last year was faster than 2022. In 2022, growth was 1.9%, and in last year it was 2.5%, well above potential. So let's just break down this growth into its component and see what was driving this economic growth. So what you see here is for last year, we break down the different components of GDP, like consumption, investment, net exports, and government spending, and see which one contributed the most to the quarterly growth that you saw in the previous slide. And you can see here that the dark blue line is consumption. That's like 2/3 of the economy is household consumption. But in terms of the changes, not just the level, but change from quarter to quarter, consumption was also the main contributor to growth. You can see that the first quarter, 2.54 contributed 2.54%. The major drag was investment. Most of it from changing in inventory. But in the next subsequent quarters, you can see all components contributed positively to overall growth. And again, consumer spending was very strong, mainly because unemployment rates remained very low during this period of time, and consumers also had a lot of cushion for spending despite high inflation rate. So one of these is accumulation of excess saving, and that also supported consumption. Student loan forbearance was still in effect, it stopped in the last quarter of 2023. So all those factors, with the combination of strong jobs, wage growth, and increase in disposable income, implies that consumers were able to spend despite restrictive monetary policy. And that showed in this output that we see. And that's why we think, like when we go into 2024, some of these assumptions will see some moderation. For example, we think the job growth that we have seen in the last year is going to moderate, and unemployment rate will go up slightly. And because of these reasons, growth will slow down compared to 2023, but we have a scenario, a soft landing scenario, where we will have, an economic growth that's, close to potential, but, without causing significant harm to several households, because we don't expect a lot of uptick in unemployment. And which is why that, we forecast the economy is going to end this year with a 1.5% economic growth rate. So let's go to the labor market. This is a strong labor market that supported, strong spending. So you can see here, the bars represent the monthly job gains since 2022. And the line graph is the unemployment rate. So 2022, the economy added an aggregate 4.8 million jobs. Last year, it added 2.7 million. 2.7 million is still a very big number, but that shows you that, the labor market is moderating. Another very important indicator that shows, that the labor market is getting into a better balance of labor demand and supply is not just the moderation in job growth, but also the job openings that we have been tracking through the job openings and labor turnover survey. At the beginning of the year, we used to have 11 million open jobs. By December, we have 9 million. So that is an observation where, employers are slowing down their hiring demand. And the number of jobs available for each unemployed person, which we call the jobs vacancy per unemployed person, it has come down from a peak of 2 jobs for every unemployed person in the country to 1.4. That's an indication that employers' demand for hiring is declining. But if you see the average monthly job gain in 2023, which is about 255,000, is still a very robust job growth. Because if you go back to pre-pandemic level, we used to have in 2019 below 200,000 job growth every month. So you can say that it's still strong, but the direction compared to in 2022, and also if you look at at the beginning of the year in 23 and what happened at the end of the year, you can see that clear sign of moderation, where we are seeing lower number of jobs being added, but still decent enough to sustain the labor market without a huge jump in unemployment rate. But we expect some of the monetary policies that's put in place, the interest rate, it works with a big lag when it comes to the labor market. Actually, research from the Federal Reserve of Chicago that investigates the impact of monetary tightening on inflation, labor market, and the economy, they found out that the tightening that's expected in the labor market is yet to come. We have seen more of the impact on economic output and price changes, but we're going to see more impact coming into the labor market. So because of that, we think the unemployment rate will tick up to 4.3 by year end. But that's compared to pre-pandemic, around 4% it's also not a huge jump, which is why one of the assumption that we say we're going to have a soft landing where price comes in, growth is close to potential, and unemployment, although it's going to go up, will not be very serious. So another important trend is wage growth. So what you see here, because in the previous 2 years, what we saw was when we see hiring demand increase and labor supply becoming very low, we've seen a significant pressure on wages. Employers were forced to add wages to their employees because they have to keep talent. And that was also, in creating underlying pressure for inflation. So at that point, actually, we were also thinking about, are they going to be a wage price spiral? But what you see here in this graph is, on the left side is a data from the Bureau of Labor Statistics showing the employment cost index. This is a very exhaustive wage data that also captures, the cost to employers, not just on wages, but also benefits. It's showing that it's coming in. So it's from a peak of, close to 6% and down to, 4.2, 4.3%. So what I have also on the right side is, that is, a high-frequency tracking of wages from the Atlanta Federal Reserve, which tracks the median hourly wages. It's not as comprehensive as the employment cost index, but I put it there because, just to show you how the wage growth trend is for the different people, like people who stayed in their current job and people who quit and then, changed their jobs, and how that trend is going. Because when the labor market was imbalanced, where demand was higher than supply, a lot of the quit rate was very high, and that quit rate means, people switching jobs and seeking for, more higher wages. And that was actually one of the drivers of this wage growth. And you can see here that blue line on the right side, the navy blue line, it's also coming down, and actually the gap it has with the overall and the stairs is also closing in. So that's one of the indications that this pressure on employment cost is also coming down. So labor market, it's coming to a better balance. Wage is also coming down. What's happening in product prices or inflation? And the same is happening there. So there is also the good news there. So we have seen inflation come down from its peak level of almost 9% to 3%, 3.3% or 3.1% in December. So what you see here in this graph is inflation broken down into two components. On one side, you have the headline inflation, which includes food and energy, the volatile items, and also the core inflation items that just captures, excludes these volatile items. It's very important to exclude this because the core is sometimes considered as, a very good indicator of where the headline inflation is going to be in the future. And I have the two inflation indices, the consumer price index and the personal consumption expenditure, because the PCE is the most favored indicator for the Fed. And actually, when the Federal Reserve is talking about the inflation target of 2%, they are talking about the PCE. But we track CPI every month. That's what a lot of consumers will see. Historically, the two have a 0.4 percentage point difference. The PCE on the low side. But what you see here, from these graphs, is yes, inflation is still higher than the Federal Reserve target of 2%, but it's really coming down. We have made a significant progress. And core CPI is close to 4% year over year, and PCE around 2.8% from a report last week. That's out of January. So this is year over year changes. We're comparing prices today to a year ago. So if we just break down the CPI and into different components and what's contributing the most to those monthly inflations. So what you see here is especially, look at the last 4 or 5 months. You can see core services is the main contributor of inflation right now. we actually have, energy and core good items, like we're seeing deflation on those areas. Prices are coming down. And food price is also we're seeing some disinflation, the rate of increase is coming down. But core services is the main driver of inflation. And from that, housing accounts actually the largest contribution. Actually, every month for the last 3 months, the BLS states that housing is the major contributor of the monthly inflation. Part of that reason is because the CPI uses a methodology that lags significantly behind from market trends, and we expect these things to catch up because real market rents are showing decline and stability, and we haven't seen that reflected in the CPI yet. We have seen some, but we've seen, and in January we also saw some kind of acceleration. So, if service is the main contributor of inflation, and year-over-year trends are coming down, what will inflation look like if we just look at, if we do a 3 months average of the core CPI and PCE, and assume if that inflation is going, if this 3 months trend or 6 months trend is going to continue for the next 12 months, where will inflation would be? So that's what this table shows you. And actually, this core PCE is submitted before the Bureau of Economic and Analysis published January PCE data. So that what you see there is changed because January came in hot. So for core PCE, both now the average 3 months annualized and 6 months annualized are 2.3%. That's close to the Fed's inflation target. And core CPI is 3.9 and 3.5%. So, and this is, what the Federal Reserve is saying that, we need more data to say convincingly that inflation is heading to target before they make any changes. On the PCE side, it looks like we are heading to target, but the CPI, it's still above target. And just for context, I have CPI, the consumer price index, all items, excluding the shelter, which is contributing above 50% of those monthly inflation data. And you can see that is also, lower. So the last mile is going to be in servicing, and some of that is due to a lagged data, but some of it is there is still some, price increases in the service sector. And looking at expectations, so in the previous slides, we look at actual data, but inflation expectation is also one of the factors that decides where inflation will be, because consumers' expectation and business expectation is also very important. And we are also seeing these things coming down in both business inflation and the consumer median inflation expectation for a year ago are significantly declining. So what's the Federal Reserve doing? Yes, economy is growing, labor market is coming into a better balance. Inflation has come down significantly, but it's still above target. So right now, the decision that they made is to hold rates where they are. And if you read the news or even the Federal Reserve minutes from January, the minutes from January, it's all about discussion about when would be the appropriate time to start cutting. And in our forecast, we built in 3 cuts throughout the year, and the terminal rate by the end of the year would be 4.5%. And if you read, like in the minutes, most of the members of the FOMC are concerned about, the risk of cutting early. So that the Fed cuts rates early, and then, inflation and, or their target, their dual target is not met, is under risk. But there were two members in that committee who voiced the risk of maintaining higher for longer, where that it could also hurt the economy. But it looks like the consensus from that meeting is the Federal Reserve is going to analyze more data, and then when that data is convincing that inflation is indeed going to target, that's when they will start cutting. But it's also important to see, the other side of the tight monetary policy. So we usually talk about rates, but the Federal Reserve has been also reducing its balance sheet or doing quantitative tightening, I guess from, beginning in 2022 of June. And if you see that, we have seen like a significant decline in Fed's balance sheet, total asset coming down from close to 8-9 trillion to 7.5 trillion. That's a significant cut in Fed balance sheet. So that's a lot of money taken out of the circulation. So yeah, so this is all about my macro presentation. So I will pass it to Liji to talk about the impact of the macro trends on consumer finance.
Hi, good afternoon. Thanks, David, for that wonderful presentation and update on macroeconomic trends. And so how are American consumers doing now? How are credit union members doing in this environment? Well, the answer to that question reminds me of that Britney Spears song, "Oops, I did it again." Consumers did it again. Consumer spending grew so strongly in 2023 that it fueled economic growth, surpassing all expectations. The economy grew 2.5% in 2023, even higher than the growth experienced in 2022, beating professional forecasters and even the Federal Reserve's consensus of slow or stagnant economic growth. So overall consumer spending grew around 6% compared to a year ago, a year before, and contrary to market expectations, real personal consumption expenditure was 10% higher than even pre-pandemic levels. The increase in consumer spending reflected increases in services and goods spending, with service consumption dominating contributions to real personal consumption over the past year. Spending on services was driven by healthcare services, food and accommodation services, and recreational services throughout the year. So consumers did have pent-up demand for fun, and they are getting it. On the other hand, consumers have also kept a strong consumption of goods, durable goods such as recreational goods and vehicles, and non-durable goods such as gasoline and energy goods, clothing, and other non-durables. And what has been driving this high and strong consumption? This chart shows that while the consumer price index inflation has been receding in the past months, private sector wages and salaries have been growing strongly, indicating that the main driving factor boosting consumption is increased real income driven by a strong and tight labor market. Median weekly real earnings rapidly increased at the onset of the COVID-19 pandemic, but soon started a declining trend up to mid-2022 due to increasing inflation. But since then, it has been recovering. So this is wages and salaries taking into account the effect of inflation, right? So as you can see on the left-hand side, the trend on the line has been increasing, even though at a slower pace than before the COVID-19 pandemic. While real wages and salaries grew at a much higher rate in the 10-year period before the pandemic for mid and high-skilled workers, real wages for low-skilled workers increased at a relatively higher rate during and after COVID-19 pandemic. And this is supported by National Bureau of Economic Research findings which indicate that the labor market tightness following the height of the COVID-19 pandemic led to a compression in the wage distribution. They observed rapid wage growth at the bottom of the distribution, mainly driven by nominal wage growth, rising job-to-job separations, especially among young non-college workers. Thus, low-skilled workers in the service sector that work jobs in the food preparation and servicing industry or provide cleaning and care services have also been bearing the fruits of comparatively higher real wage post-pandemic. Last year, we alluded 2022 strong consumer spending and solid economic performance in part to excess savings resulting from pandemic government support programs. A big question that has repercussions on how the economy unfolded in 2023 and how it will unfold in the near future is whether excess savings have been spent up or if there are still some circulating in the economy that might keep boosting consumption and henceforth affecting economic growth. So even though there are multiple theories when it comes to the status of pandemic-era excess savings, when it comes to excess savings, distributional effects matter. So, for instance, some economic think tanks project that excess savings were still high in the second quarter of 2023 at around $1.3 trillion. Others estimate that excess savings have been mostly spent down and that they were virtually down to $200 billion at the end of 2023. So, but when it comes to excess savings in relation to consumer spending, distributional effects matter. Researchers from the National Bureau of Economic Research developed a framework connecting the distribution of excess savings to households and the dynamics of aggregate demand. They call this framework the trickling up of excess savings. According to this analysis, one person's spending is another person's income. And under this premise, they show that excess savings from debt finance transfers have much longer lasting effects than naive calculations would suggest. So the authors describe the trickling up of excess savings in this figure, in which households in the lower and middle group of the income distribution who have a higher marginal propensity to consume first stimulate aggregate demand through spending, transferring their excess savings to higher percentiles of income, increasing other households' income and their excess savings. This leads to a long-lasting increase in aggregate demand until ultimately excess savings have been trickled up to the top 1% of the income distribution, who have a very low marginal propensity to consume, and thus ending the effect on spending and growth. According to this theory, the trickling up of excess savings will take up to 5 years to take effect, even with tight monetary policy and high inflation. We are now at around 11 quarters after the last disbursement of economic impact payments. And as you can see on the left-hand side, that chart shows that at this point, after around 10 quarters, there's virtually almost no excess savings in the hand of the bottom 80% of the income distribution. And that's where we can situate our credit union members, right? They're usually in the middle income groups. And so I guess this most resonates with what you are seeing in your members' savings accounts, that the excess savings have virtually been exhausted. Research from the Federal Reserve Bank of San Francisco analyzed post-pandemic trajectory of American households' aggregate net worth compared to its pre-pandemic trend. But they take into account different levels of liquidity, of asset liquidity. What they find is consumer spending, what is important for consumer spending is that checking account balances substantially increased after the COVID-19 pandemic, and they have remained at an elevated trend when compared to pre-pandemic trend. So that is the red line on the right-hand side. And this definitely signals that consumer spending can keep high, in the near future. So this signals more room for increased consumer spending, with stimulus money transitionally moving upwards in the income distribution. And how are consumers feeling? For the most part of 2023, consumers felt a vibe of recession. A Bloomberg columnist coined the term vibe session to refer to historically depressed consumer sentiment in the face of solid economic data. In a year when the economy grew at around 2.5%, the consumer sentiment index remained under historical average, and it was more in line to the consumer sentiment observed in recessionary periods than in a booming economy. But who is to blame? You just have to turn on the news to realize how fragile housing finance and economic stability might appear. On one hand, the conflict of Gaza and Israel could further escalate into a wider region, a region that produces around 35% of the world's oil exports, and generate further commodity price spikes and geopolitical shocks. On the other hand, the sustained invasion of Russia in Ukraine also risks generating fresh supply shocks to economic recovery, with spikes in food, energy, and transportation costs. Only in 2024, we're starting to see a bounce in consumer sentiment as Americans increasingly recognize the strength of the economy. However, skepticism hasn't disappeared, and there's a fear that consumer finances are fragile and that a recession is just around the corner. Even though data doesn't support that, consumers feel as though the economy is indeed on the brink. Coupled with low consumer sentiment, another headwind in the consumer sector is the potential negative effects that the lift of the student loan forbearance can have on consumer spending and on credit union asset quality. It has been estimated that the amount of student loan payments foregone during the forbearance amounted to around $185 billion. With the resumption of payments and all that money away from households' disposable income, we will probably see that will affect economic outcomes. But perceptions aside, how are Americans' households' balance sheets doing? While consumers are just starting to sense the upside of strong economic performance, boosted investors' confidence in the economy is reflected in record high stock valuations. The Standard & Poor's 500 index surpassed the 5,000 mark for the first time in modern history. And as of last week, the index was 19% higher than its pre-pandemic mark, around 7% higher than its pandemic height, and 12% higher than the start of this year. Thus, the 55% of households that do have a participation in the stock market keep benefiting from strong economic performance and strong investor confidence, which has also been positively impacted by expectations of monetary policy easing this year. So how are home prices doing? How are real estate assets doing? So as of November of 2023, the Case-Shiller National Home Price Index grew around 5% with respect to the previous year. And this year-over-year growth in home prices reflects a reversion back to pre-pandemic growth, though it is still a little higher. In fact, the National Home Price Case-Shiller Index is still at almost an all-time high. This means that home prices are still in an elevated trend, which translates to higher value of households' real estate assets and positively impacts the balance sheets of 70% of Americans who do own a home. Households' debt as a percentage of disposable income has shown a deleveraging trend over time, with households currently being much less indebted than during the Great Recession. And data suggests that this deleveraging trend has been consistent across the entire income continuum. Liabilities as a percentage of assets have decreased across the board over the last 4 years. For the bottom 20% of the income distribution, from the 20th to the 40th percentile, from the 80th to the 99th percentile, and for the top 1 percentile. In fact, lower income groups have seen a relatively larger drop in liabilities as a percentage of assets because of the use of COVID-19 pandemic stimulus checks to pay down debt. Households' net worth as a percentage of disposable income is still holding up. And as of the third quarter of 2023, it was 743%, which is lower than the pandemic peak value of 826, but it's still higher than the pre-COVID level of 649%. Thus, the positive effect of higher than normal house prices and higher than trend stock prices, coupled with the debt-reducing effect of COVID fiscal payments and consumers' balance sheets rebalancing, is still reflected on relatively high household net worth. But we do recognize that there is a lot of inequality, and only 55% of households own stocks, and only 70% of them own a home. And thus, not all Americans benefit from strong asset valuations. So to understand a little bit where credit union members fall in this wealth continuum, I'm going to show you some statistics from the Federal Reserve Bank. So according to the Federal Reserve Bank Survey of Consumer Finances, mean net worth grew a record high pace during the 3 years following 2019. Mean net worth in 2022 came in at just over $1 million, defining the average American as a millionaire. However, the average is heavily impacted by the ultra-rich, right? By those consumers that are on the far right tail of the wealth distribution. But for matter of comparisons, while bank customers' mean net worth was $1.3 million in 2022, credit union members' mean net worth was less than half that amount, at around $500,000. If we turn our attention to the median net worth, that is the wealth of the household right in the middle of the wealth distribution, and this factors out the effect of outliers, we see that while bank customers' median net worth was $219,000 in 2022, credit union members' median net worth was $40,000 less, at around $178,000. So irrespective of how we define wealth, without a doubt, credit unions are strong on their mission of helping Americans of more modest means reach financial well-being. Unfortunately, for households that don't use neither credit unions nor banks as their financial institutions, that is, households that are generally unbanked, their mean net worth went down during those years. So we also track this FinHealth score, right? FinHealth score is an index that measures consumers' financial health based on their ability to spend, save, borrow, and plan. Consumers ranked as vulnerable are consumers that are struggling with almost all the aspects of their financial lives. Financially coping consumers are those that are struggling with some aspects. And financially healthy consumers are those who spend, save, borrow, and plan in ways that enables them to pursue their dreams, to pursue opportunities, to thrive. Findings from the 2023 FinHealth Pulse report indicate that the percentage of financially vulnerable Americans returned to pre-pandemic levels. So around 17% of Americans were financially vulnerable in 2023, and that is an increase from the 15% of financially vulnerable Americans of 2022. With younger Americans, Black and Latinx disproportionately experiencing increases in financial vulnerability. Considering this declining financial health among historically disadvantaged populations, the FinHealth network underscores the continued need to keep equity front of mind when developing products and policies to support financial health. In 2023, around 4 to 5% of American households were reportedly unbanked, that is, without a bank account, and around 14% of them were considered underbanked. That is, they have a checking account, a share account, but they also use transaction products or predatory financial services. For the around 6 million unbanked households, not having access to a share account can make it more challenging to accrue interest rates on savings and have access to credit products that can potentially help them build financial resiliency and reach long-term goals. In fact, the FinHealth Pulse survey finds that while only 11% of fully banked households are financially vulnerable, almost half, or 47%, of unbanked households are considered vulnerable. Likewise, 1/3, or 32%, of underbanked households were financially vulnerable in 2023. So this highlights numerous opportunities for growth for credit unions and multiple and diverse ways in which credit unions can keep spreading the love through their mission of people helping people, especially those who need it the most. Just to summarize, the main factors driving the consumer sector are consumer spending is still strong, with real income increases boosting consumer spending. Household net worth is still solid, but we're also expecting longer-term effects of excess savings for some consumers. On the downside, there is still pessimism in consumer sentiment, and the lift of student loan forbearance can have potential negative effects on consumer spending and credit union asset performance. Increasing financial vulnerability for some Americans is also a factor that we also need to keep in mind. So, Kurt, what does this mean for credit unions? How are credit unions faring in the current macroeconomic and consumer environment?
All right, thank you, Liji. Yeah, so it's my pleasure to get to try and take everything we presented so far and filter it down into our industry. What does it mean for credit unions? So I was thinking about a way to sort of synthesize this into a more systematic way, and I thought, you know, in talking to credit unions and also just in looking at the data, the one challenge, I know there are myriad challenges you're facing right now, but if there's one thing we hear on a consistent basis, it is that margins are getting tight. Earnings are difficult right now, right? So I wanted to try and take a look through the lens of earnings in particular at our outlook for the industry. I will, however, allow myself a few detours along the way. So you can see here the trend in ROA along with the forecast from America's Credit Unions team for 2024 of 50 basis points. And I actually don't show enough of a history here to catch the last time that we had an ROA of 50 basis points or lower. The last time that happened was 2010. So, you know, I don't want to be an alarmist. I don't think 50 basis points is a catastrophe, but it does emphasize that you all are facing a difficult earnings environment from a number of different pressures being placed upon you. So let's start with the biggest component of earnings, net interest margin, and you can see very clearly the roller coaster that we've been on the last few years. Of course, the big dip in net interest margin with the onset of the pandemic, and then a very rapid recovery in 2022. However, in the last couple of quarters that we have data for, we have started to see that turn. And I think, you know, again, conversations that we have with credit unions, cost of funds, right, is at the forefront of your mind. Those funding costs are really starting to bite on earnings. And, you know, I think despite what we've said about maybe some potential for rate cuts later this year, you're probably not going to see the relief from that in terms of your funding costs until maybe 2025. And so that's in large part why we do have this outlook for ROA. Now, I said I would allow myself a few detours. As long as we're talking about funding, let's talk about share growth briefly. Again, you can see the dramatic moves we've had in share growth recently. I know liquidity has been, you know, if it's not margins tightening, Liquidity has been the other challenge that's been at top of mind for many credit unions over the past 12, 18 months. And, I like to look at the good side of things. The last couple of quarters, we have started to see, I'll call them green shoots, because we're still not seeing share growth back to the level that we need it to be. But at least on a seasonally adjusted basis, it's above zero, it's positive, and that wasn't the case, in the couple of quarters prior to that. However, you can see, based on the Americas Credit Union team's forecast for 2024, we're not expecting a major improvement in share growth. We still expect it's going to be continuing challenges. Liquidity is scarce out there, and everyone is still fighting very hard for shares and deposits. Borrowings, of course, one way that a lot of credit unions are addressing shortages in liquidity. And I guess the good news is that borrowing growth has started to recede a bit, maybe indicating that some of those liquidity stresses are easing just a bit. And yet, it's still at a pretty elevated level. Based on the last quarter of data we have, 30% annualized growth in borrowings. And so, again, there are still a lot of stresses out there. And again, as we think about how this plays into funding costs, of course, all of these borrowings are sort of locking in a lot of those costs. A lot of the CD specials that you're running right now are going to be locked in for some amount of time. And that's why we don't expect to see a lot of relief here in 2024. All right, moving to the next component of earnings, PLL, provision for loan and lease loss expense. And more than any other component of earnings, this is why we've seen this, the big downturn in, the downturn in earnings over the last 18 months. Basically a 50 basis point increase in PLL expense from virtually zero at the end of 2021. And of course, this reflects a number of things, one of which is the implementation of CECL, but the other is that delinquencies and charge-offs are rising. And they're not just rising for you. I wanted to show this slide just to illustrate that. We've got here, this is delinquencies plus non-accruals for credit unions, community banks, and large banks. And you can see that no matter what type of institution, everyone is seeing delinquency rates rising. And that's our expectation for 2024 as well. The team expects delinquency rates to continue to rise, but maybe at a smaller rate than what we saw in 2023. And I think this speaks well to some of the factors that Liji talked about. We've got a lot of cross currents when it comes to households right now, because real wages are growing. There's a lot of ways that the household balance sheet looks strong, and yet, pessimism is what it is. And we are seeing delinquencies rise for certain households. While we're talking about lending, let me just briefly talk about overall loan growth as well. Again, just dramatic volatility in recent years. We did see a lot of moderation in 2023 as loan growth came down. I think liquidity has been, probably the biggest factor there. Also, delinquencies rising has perhaps compelled some credit unions to pull back a bit. And as I've suggested, I don't think the team expects those challenges to go away overnight. And that's why we're expecting pretty muted loan growth again in 2024 of just 4%. Last but not least, talk about fee income, which has been on a steady downward trend since over a decade now, especially since the pandemic, the onset of the pandemic, down 14 basis points since 2019. If you go out a little further, down 25 basis points over the past decade. When I look at this chart, I like to imagine someone who has no idea, is totally naive about the financial services landscape, they're totally new to the topic, and I would like to ask that person, at what point in this period do you think regulators, regulatory and legislative scrutiny over fees was at its greatest level? And I doubt anyone would say right now, when fee income is at its lowest point, and yet that's the environment that we're in. So, again, as Mike mentioned right at the outset, we love doing this, we love doing these forecasts, we love talking about the economy, but our core responsibility is as advocates to support the America's Credit Union's advocacy agenda. And we do that with data. We do that to demonstrate to policymakers that you are fulfilling your mission, that you are good actors. And so, of course, the legislators and regulators have given us a lot to work with this year. Briefly, the Share Insurance Fund, I'll be quick about this, but I think overall the fund is very strong. The NCUA has really shined a spotlight on the rise in CAMEL's 3, 4, and 5 credit unions. That's shown in the gray line there, and it's true that there has been a recent rise in the CAMEL's 3, 4, and 5 class. However, it's interesting because right on the heels of mentioning that, they will say that's why we, as the NCUA, need more authority over the SIF to charge more premiums, to retain more equity in the fund, and yet their own loss models don't seem to buy it. The purple bar there is showing loss reserves, and those remain at a very low level. And I think that meshes with what we see, which is that the fund overall is in very good condition. It's been very strong over its history, and we don't see any reason to yield on what are the current authorities for the NCUA. And last but not least, I wanted to just show you a table of the NCUA supervisory priorities. You see not only the priorities for 24, but also going back, sort of like a trip down memory lane. I remember when everyone was thinking about LIBOR transition. That was on the priorities list 3 years in a row. Seems like a distant memory now. But 5 supervisory priorities in 2024, and really the topics that we've dealt with are integral to 3 of those. We've got credit risk, interest rate risk, liquidity risk. So I think regardless of where your credit union is with each of those risks, be cognizant of the fact that as an industry, the NCUA sees the same charts that I've just shown to you, and so that's what they're stressing. And so at your next examination, I would expect those to be areas of focus for your examiner. So I know we have just a few minutes left. I think I see some microphones out in the audience.
There's one right in the middle there for sure.
All right. I know we have a microphone right here. So if you have any questions, I think the team would love to field a question or two.
Thank you for the information. I've got a few questions real quick. One, what is the bank equivalent of the percentage of fees for average assets? It'd be an interesting point for lobbying when we're meeting with our members of Congress. And then a follow-up would be, you mentioned that the Federal Reserve has been shrinking its balance sheet, and it's arguably necessary. How much more stomach do you think they have to continue?
Yeah, so I can maybe take the first question since it was about fees.
Yeah.
Off the top of my head, I don't know what the fee income ratio is for banks. It's a tough comparison because banks do so much in addition to retail banking. And so when you just have total assets as the denominator, sometimes that number is going to get diluted when you're just looking at fees related to sort of retail banking. That said, that's a good question, and I think a good one for the team to look into. That would be a good number to carry with you into your meetings this week.
Yeah, about the question on the Fed Reserve, the runoff from the balance sheet, I'm going to tell you what is included in the minute from the January 30 and January 31st meeting. And in that meeting, in that minute, it says that you know, in the next meetings, there needs to be an in-depth discussion about slowing down the pace of runoff. No more specific detail is indicated, but I believe, you know, in the subsequent meetings, like, we will hear more about that.
I mean, I think one of the really important things to keep in mind is that our baseline forecast has the economy growing at a fairly decent, slower but decent rate. But against that backdrop, we do think that the unemployment rate is going to drift up a bit, not dramatically, but enough for a lot of people to notice. So I think based on our assumptions, we're looking at somewhere in the neighborhood of 750,000 or so more people out of work. That's meaningful, and not just for those 750,000 people, but for their families and for their communities. And that will become more obvious to the Fed, and not just on the long end, but on the short end, they will more than likely take action. But I do think, as sort of reflected in those notes from the meeting, they're going to be cautious about it. It took them a while to get inflation down, and they're going to be very careful about doing something dramatic that will push it right back up. So.
Yep.
I don't see anybody at the microphone. I'll just throw a question out. So let's go in order maybe and talk about what we see as the major risks to this relatively rosy baseline forecast. You want to start, Kurt?
Sure. I think from a macro level, my concern right now is that if trouble emerges, the Fed is not going to recognize it. I think we've started to see some indications that there may be trouble in the labor market, and yet that data has not been dispositive. You could argue either side of it, and so with inflation not yet all the way back to where the Fed wants to get it, but still trending in the right direction, I think I'm worried that there could be a little bit of complacency on the Fed side, and that while they have all of this, we'll call it ammunition to address shortages and growth, I'm worried that they may not use it at the right time.
Luigi?
Yes, well, so I think I mentioned, right, and I agree with consumers that probably the main risks come from outside, right? The geopolitical risks, we have 2 war zones right now, and one of them is in a very important region for oil exports, so having oil price shocks that can destabilize this path that we have been going through of decreasing inflation, that can bring us back to square one, basically, and have the Fed, stop cut rates. And so that definitely could be a big factor for the economy.
I think from a global perspective, probably, there is a slowdown in economic activity in China. China is the second largest economy in the country, in the world, and has a lot of trade relations with the U.S. So we are seeing that significant decline. So that could also have an impact on overall global slowdown. And the U.S. is to a great extent protected, but there are some exporters that rely on exporting to China.
Absolutely.
And probably a flooding of cheaper products.
I mean, I'm completely in line with you. I look at China and I think to myself, it's not just weaker growth, right? I mean, it's the idea of a stock market that's almost collapsed, a housing market that looks like it's collapsed, and just a total lack of confidence in the consumer sector there, which seems like a big deal, especially when you look at it through the lens of what's happening here, a stock market bubble and a housing market bubble, and you have the money supply falling, and the last time that happened, we went into a Great Depression. Also, I think, I look at the data on the percentage of loan officers at commercial banks that are tightening credit on net. That's still very positive. So banks are still tightening, even though we do see demand in the consumer and business sector. That seems like it could be really problematic. So there's sort of a bunch of things that are bubbling up that that not just concern me, but concern you as well. Luigi, what you mentioned about energy is a really big one because historically energy price shocks have led to recessions, right?
Right. Yeah.
So relatively rosy forecast. Stress in the credit union sector for sure. And a lot of things that we're very concerned about in terms of whether this baseline forecast actually turns out the way we think it will. Yeah.
I appreciate the rosy prospects of the economy and where we are and where we didn't go. One thing that concerns me that nobody talks about is one, the national debt, interest rate on the national debt. There's a limit to where we may not be able to grow out of that in terms of the national debt. And second, I read recently in the last few months, consumer credit card debt just exceeded $1 trillion. You know, and we talk about the consumer not having so much confidence, or maybe the individual confidence isn't real high, but when people have that burden of a high consumer card or credit card debt and the interest associated with it, kind of takes a little bit of the wind out of their sails. Could you just kind of address your thoughts on those couple of topics? Thank you.
You want to start, Kurt?
Sure. I guess I get to go first. Yeah, I think on the national debt, I think a lot of people are talking about that issue. I think that's getting a lot of news coverage, and certainly here in Washington, D.C., and it's why we have to be so vigilant about our number one priority of defending the credit union tax exemption. That job only becomes more salient as the debt grows. I think you're starting to hear more concern about certain programs like Social Security, not imminently, but maybe in the next 10 years could be exhausted. And so I think policymakers are going to be confronted with more difficult questions at one point or another. So I don't think this is, I don't think the debt is something that's going to cripple growth in the near term, but it certainly could have long-term effects. And then maybe I'll throw it out to the group.
I mean, I totally agree with that. It just feels to me like I don't think there's a danger of any kind of meltdown because of the debt situation, but it does limit what you can do from a policy perspective, and the kinds of things that we would like to do, like educate more people and help people with a social safety net maybe that would help them avoid hiccups and that sort of thing. It's harder to do all of those very positive things from an expenditure perspective when you are spending that much money on the debt service. So I think that's the biggest deal. We just have fewer choices, and from a social perspective, that's problematic.
Yeah. And I'd like to answer on the credit card debt, the question on credit card debt. It is true that credit card, the balance on credit card, exceeded the $1 trillion as you mentioned. But I think it's very important, because we are also, we were concerned about this, and we looked at it because we have the consumer data, Equifax consumer data, and we looked at this balance, by different credit profiles, and in another news, we have also seen, delinquency for credit cards also going up, not just the balance. So we try to break that down to see if there is any risk to, to the economy or to the financial institutions. But what we are seeing is, yes, when it comes to the, not paying on time, we are seeing a problem in subprime and near prime categories. But we have to see, the people with good credit scores are paying on time, and we should also, I think, dig deeper, not just look at balances, but different credit card programs where people are using their cards, you have these reward programs, because they get some return for every point they spend. So are they simply just, accumulating real debt, or are they just simply, paying off the balance and then, enjoying the benefits of these reward programs? So yes, there is, some concern But just the fact that credit card debt exceeded $1 trillion by itself should not be alarming.
Well, for the last 5+ minutes, we've been looking at a sign down here that says "wrap up." So I think we'll do that. But in closing, I just want to say that as a credit union director, I think given this forecast and the stress that we're seeing in credit unions and we're expecting in credit unions, really important to remember that credit unions were created in the depths of the Great Depression because banks weren't helping people. And our model basically is unique, and its uniqueness stems from the idea that whenever there are hiccups and there's trouble and people are having a tough time, we look at that as an opportunity. So we step in and we help people through tough times to get them from point A to point B faster than otherwise. We use care and concern to help people. On the other hand, in the for-profit sector, essentially by law, they have to do the exact opposite. They're not there to protect people. They're there to protect institutions and their stockholders. So keep that in mind. We are essentially financial first responders. That's what we were chartered for. And yeah, you might be pursuing your strategic plans in a slightly slower way over the course of the next year or year and a half. But it's really, really important to do whatever you can to help people get through the tough times that they're going to be dealing with. So thanks everybody for coming out. And we can come down here, and if anybody else wants to talk, we can talk to other, address your questions if you have others.
Okay, we need to go.
Thank you.
Thank you, Mike, DeWeet, Lee, G, and Kurt. We appreciate your insights. Very informative as always. We appreciate the generous support again of our session sponsor, FIS. And friends, the exhibit hall is now open. Enjoy the rest of your afternoon and evening, and we'll see you right back here tomorrow morning. Have a good one.